Hey everyone, welcome back to another Explainer. I'm absolutely pumped you're here today because, well, we're looking at a literal masterclass in brand management and financial execution. We're breaking down the numbers behind Deckers brands, the absolute powerhouse behind names you definitely know, like UGA and Hoka. They just dropped their fiscal 2026 earnings, and let me tell you, it was a massive record-breaking year. We're going to use these numbers to cut right through all that dense financial jargon and see exactly how they pulled this off. Okay, let's dive into our roadmap for today. First up, we'll look at the record-breaking fiscal 2026. Then, the Hoka and UGG engines. Third, channels and global reach. After that, shareholder value and cash. And finally, their multi-year financial horizon.
All right, Section 1, record-breaking fiscal 2026, the top-line growth.
To really appreciate the scale of what Deckers achieved this past year, we've got to wrap our heads around the sheer volume here. $5.47 billion. That is their record-breaking full-year revenue for fiscal 2026. To put that into perspective, it's a 10% increase over the previous year. Now, 10% growth might sound kind of standard if you're a tiny startup. But for a company already operating in the multi-billions, adding roughly $500 million in new revenue in just a single year is a massive achievement. But it's not just about selling more shoes, right? It's about doing it profitably.
Which brings us to $7.02. This is their diluted earnings per share for the year, representing an 11% increase. This is absolutely crucial because it showcases true bottom-line growth. They aren't just out there pushing volume and sacrificing their margins to get it. Their earnings are actually growing slightly faster than their revenue. That right there is the hallmark of a highly efficient, well-oiled operating model.
And hey, you don't have to just take my word for it. Here is exactly how Steve Fashing, their chief financial officer, framed it in the earnings report. He notes the exceptional performance, but pay close attention to that phrase right in the middle. Industry-leading operating margins. That is the secret sauce here. They're managing their costs incredibly well while continuously expanding their global footprint.
Moving right along to Section 2, the Hoka and UGG engines powering the portfolio.
Just consider the explosive momentum of Hoka. In fiscal 2025, they did $2.233 billion. Then, in fiscal 2026, that jumped to $2.587 billion. That is a whopping 15.9% jump in revenue. Hoka has basically transitioned from this niche running shoe into a total mainstream lifestyle and performance juggernaut. And the data shows us that demand is literally only accelerating. This dual-engine dynamic is perfectly captured by CEO Stefano Carati. He specifically points out the continued momentum of Hoka right alongside the enduring strength of UGG. It's honestly a brilliant strategic balance. You've got Hoka providing the explosive, high double-digit growth, and UGG acting as this massive, reliable, and growing foundation.
Let's break down how that portfolio balance actually shakes out in total revenue for the year. UGG is actually still the reigning champion in terms of total volume, bringing in $2.739 billion, which, by the way, was a very solid 8.2% increase all on its own. Hoka is right on its heels at $2.587 billion. Now, you might notice that little sliver for other brands at $146.2 million. This segment actually saw a decline this year, but actually, scratch that. It wasn't a bad thing. It was totally planned. The report notes this was driven mainly by the strategic sale of the Sanuk brand and phasing out Koolaburra standalone operations. Basically, they're trimming the fat to focus entirely on their two main engines.
Okay, on to Section 3, channels and global reach, or basically where the sales actually happen. Notice the stark contrast in regional growth here. Domestic net sales are essentially flat at just 0.2% growth, stabilizing around $3.192 billion. But internationally, sales absolutely exploded, with 26.8% growth, hitting $2.281 billion. This tells us loud and clear that Deckers is successfully exporting the Hoka and UGG phenomena globally. The international market is, without a doubt, their most aggressive growth frontier right now. And if we break down exactly how consumers are buying, we see another super interesting dynamic. Both channels are growing, sure, but wholesale was the primary driver of the revenue increase this year, jumping 12.3% to over $3.2 billion. Direct-to-consumer, or DTC, still grew a really healthy 6.3%. This combination shows us that retail partners are eagerly stocking Deckers products, while the brands are still maintaining those strong direct relationships with their most loyal customers. Next up, Section 4, shareholder value and cash. Let's talk financial fortitude. So, when a company pulls in nearly $5.5 billion in revenue, what does the bank account actually look like? Well, to answer that, let's look straight at the source. On the official consolidated balance sheet here, right under current assets, is cash and cash equivalents. See that number? $1,907,249,000. Almost $2 billion in pure cash just sitting on the balance sheet. Crazy, right?
Let's summarize what makes this balance sheet an absolute fortress. Not only do they have that $1.907 billion in cash, but they also have zero outstanding borrowings, literally no debt. Furthermore, they generated over $1 billion in free cash flow just this past year. And remember, free cash flow is the cash generated from operations after all those strategic investments are already made. So the big question becomes, what does a company with absolutely no debt and $1 billion in fresh cash do with it all?
Well, they authorized this massive number right here, $5 billion. The board of directors just approved an increase to the company's stock repurchase authorization, bringing the total to approximately $5 billion. When a company buys back its own stock, it reduces the number of shares on the market, which directly increases the value and the earnings power of every single remaining share. It is a massive, incredibly confident return of capital directly to the shareholders.
Let's look ahead. Section 5, Multi-Year Financial Horizon, 2027 and beyond.
That level of capital return requires extreme confidence in the future. For the immediate near term, their fiscal 2027 guidance is straightforward and highly optimistic. They're expecting a continuous, steady upward trajectory with high single-digit consolidated revenue growth. And hey, remember that $7.02 earnings per share we saw earlier? They project that to climb to between $7.30 and $7.45. So, that profitability engine, it just keeps on churning.
But they didn't just stop at next year. They laid out an explicit multi-year framework all the way through 2030. They are targeting high single-digit overall sales growth every single year. How? By keeping Hoka growing at low double digits and Uggs growing at steady mid-single digits. Crucially, they plan to maintain those industry-leading operating margins in the low 20+% range. All of this, combined with that massive share repurchase program we just talked about, is perfectly engineered to deliver low double-digit earnings per share growth year after year. And that brings us to the end of our analysis. But I want to leave you with a thought before we wrap up. As Deckers scales internationally and continues to push Hoka and UGG into entirely new categories, what new product and operational innovations are actually going to be required to maintain those elite low 20+% operating margins through 2030? I mean, it's a pretty high bar they've set for themselves. Thank you so much for joining me today. I hope this explainer showed you how taking the time to structure and visualize dense earnings data can reveal a truly fascinating strategic narrative. Keep learning, keep focusing, and I will see you on the next explainer.